can invite Mark, Petronella and Philip to the stage. You'd be pleased to know that the gifts for the speakers are in recycled paper bags. The chocolate is handmade in small batches from sustainable sources, and the book is just from Amazon, but we got part of the way. So our final panel of the day, and I'm going to stand up in a minute to get questions. I just want to introduce our panelists, and they're each going to offer a view. What we're trying to do here is sort of pull together some of the themes from the day in this big debate about the shape of flows. So we've got Mark Dampier, Head of Research for Hargreaves Lansdown, Philip Martin, who is Business Development Director for Unique FP, and Petronella West, who's CEO of Investment Quorum. Thank you all for joining us. They're each going to do a few minutes of their view on some of the issues around shape of flow and shape of fund flows, and then we'll open it up to a debate. So Mark is the architect of the Wealth 50. It's got a little bit of press recently, so there might be some questions about that. He joined Hargreaves Lansdown. He's regretting accepting my invitation now. He joined Hargreaves Lansdown over 20 years ago as research director, and I don't think we need to go into your CV beyond that, do we?
No.
I'll pass to Mark to give his view.
Okay. Well, I won't keep you for 5 minutes because I was really interested in Roma Lee's thing earlier on because one of the reasons we've gone to less or fewer funds, I should say, is actually clients don't want too much choice. The original idea, which was mine, was that I'm talking to audience who already know this, so forgive me for telling you what you already know. In terms of active funds, there's 2,500, 3,000 funds, of which about 95% are totally useless. So the idea was to bring, and it confused clients. I mean, when I arrived at HL, and I was an IFA before that, they just had this huge choice of which people just kind of say, well, I won't do anything really. So I reckon that we could bring it down to a more of a universe. So the Wealth 50, Wealth 150, whatever we want to call it right now, was really an idea to just reduce a huge amount of funds down to a list that people could actually kind of deal with. But actually over the years we found that, well, one is that the list got fewer anyway because our own quant-based systems were saying there's fewer good fund managers anyway. And clients at the same time were saying it's still too many funds. They wanted less choice. And I was listening to Roma Lee's panel with ETFs and all the SMAs. I thought that was really fascinating. But my God, most clients are completely, I mean, the whole passive industry has exploded, but are clients buying more of them? Well, maybe, but there's actually now more passive funds than I think there are active funds. So talk about, I mean, for clients, and most clients really just want a solution. I just think it's sort of completely mad. We pile on, and worse still, we then argue amongst ourselves. Because I've been parts of debates about investment trusts, unit trusts. We could see the ETF. And the client, just imagine a new client, and we want new people coming into the industry. And my God, all they see is us arguing. So all they look at is say, well, if these blokes and women cannot make up their minds what they should be buying, well, how the hell can I? What chance have I got? So actually, as an industry, I don't think we've helped ourselves in making things simpler. My own view of fund flows, well, actually, it's a bit of an oxymoron at the moment because they're not flowing. Because the combination of Brexit, Trump, China, and everything else, I think, personally, as I'm one of the older people here, I can remember 1988 as being my worst year in my career, actually, in finance, because the 87 crash was so shocking to people that no one wanted to do anything in 88. But it's not quite that bad, but it's a sort of similar experience at the moment. And if you give clients deadlines, I mean Brexit-type deadlines, and we saw it in 2012 with Brexit, they just don't want to do anything. I mean, the whole of 2012, they kept on bringing another deadline on, and the client would say, oh, I'm going to wait until next Sunday because there's an election, there's something else. Well, we've got the same thing with Brexit. So until that gets out of the way, I don't see funds flowing terribly well.
No, they're not. They're not. And it's interesting because a lot of people ask what the impact of Brexit is, but then if you look at the at other markets, there's a similar slowdown. So there's a number of factors feeding into that. So Philip Martin is, I mentioned Business Development Director, Unique FP, a financial planning firm. And I asked Philip to join the panel because of the trend towards unitizing, so financial advice firms unitizing, because you were involved with that at Openwork and are now a user of that solution, yeah?
Yes, it's very odd. I've ended up having to put my money where my mouth is and put our customers' money into something that I created myself. So, yeah, I mean, I come at this very much from an advised part of the market rather than direct. And I think the direction of flows in future may be different down those two channels. I would expect them to be. As you mentioned, at Openwork, along with half a dozen other businesses of size and scale, they have moved away from best buy lists or from choosing from the totality of the market to seeking to manufacture funds themselves and become authorised corporate directors, become ACDs. Historically, that was a relatively simple thing to do with the regulator. I mean, there'll be many people in this room that will remember the horrors of broker funds thousands of years ago. And even 15 years ago, there were some decent-sized regional IFAs who were running hosted funds where they themselves weren't the ACD, somebody else was, but they were dabbling around the fund management that was happening within the funds themselves to pretty horrendous outcomes in terms of cost to customers and outcomes. What I'm talking about here are firms who are actually taking on the same permissions that every fund manager actually has as an authorised corporate director. And I think that will increase, but I think there is a natural cap on the number of firms that can do that. Many would like to, because they see the opportunity to capture more margin. Not many will be able to because it's a size and a scale game. It's now properly regulated for a start. So you have to run this with an infrastructure where even if you are subbing out the management of not only the management of the money, but things like custody and TA work and fund accounting, you're having to have an infrastructure in-house that understands those aspects of running the fund, is mirroring them, and is checking them because you're on the hook for it. You have the regulatory responsibility. So running that form of business costs somewhere between £1.5 million and £2.5 million of straight cost in order to run it. So it's only ever going to be big businesses like Openwork, Intrinsic, TP, Tenet, if they were moving, who can start to enter that space because of the cost base to do so. I would argue, I mean, we'll maybe come on to this when we debate it a bit further, that there's a real fork in the road about how that is deployed. It could be deployed because you're then aggregating your customers' money, which has power and has buying power, and it can be used to drive significant margin to you as the guardian, let's call it, of your customers' cash. And many firms have done that and have made plenty cash and continue to make plenty cash to do so. There's another way to do that, which is to share the economic benefit, because of course you control the pricing of these underlying funds. And that was what we tried to do at Omnis in a very modest way, but we were able to offer funds at 5 or 10 basis points cheaper than the prevailing marketplace because we were not seeking to make as much margin as we could do. Don't want to get all holier than thou about it, but I think with control comes some sort of responsibility. The last point I would make about this is that I think this is far easier to execute in a restricted proposition than it is in an IFA one, because you actually understand, A, what the flows are going to be and where they're going to be directed to. In an IFA proposition, I'm making no judgments between the two, but in an IFA proposition, if I'm running an IFA network, I haven't the slightest idea where funds are going to end up, no matter the fact I have a best buy list, because I don't actually control the end advice for that part of the advice process. So I think the most successful ones that have grown the fastest and been able to operate best have been in the restricted space. Obviously, SJP had done it in a different way through a life company initially for 20, 25 years, but the majority that are doing so are restricted in themselves. And I think those businesses are going to grow. I think they will start to acquire other practices. I think IFAs are already beginning to start to fold into the restricted world. And as that happens, I would expect advised flows to start to move more into these propositions than are currently happening in terms of being invested into the wider market, if that makes sense.
Yeah. Great. Okay. And Petronella, so you run Investment Quorum. You don't unitize your own offering. You're discretionary. So let me see, boutique financial planning and discretionary investment manager. I read your website. So Petronella is seeing clients on a day-to-day basis and very client-focused. And I love there was something in your bio that I really like, that the fun starts when based on a close relationship of trust, you can start solving what your client perceives as a problem, which I think is fantastic. It's that perception of problem, but also that foundation of trust. Petronella is also heavily involved in a charity in Sierra Leone called Street Child. So anyone who's interested in finding out more about that, we'll do that over drinks later. But can you do your intro bit about Shape of Flows?
Yeah, I don't know about anybody else here, but I've had a fascinating day listening to everything, but I'm really, really confused by lots of stuff. And if I'm really confused, I've got no idea what my clients think about it all. So, and I'm front-ended, and the really good news would appear to be that, according to the Orbis gentleman over there, I seem to be in control of the fee conversation, which is also quite good. And the other good news is that we have quite a lot of flows coming into our business, so we're clearly doing something right. In terms of where the flows go, so we became discretionary in 2006, and we manage just a little bit under probably 300 million now. And we have a centralized investment proposition, and we have a fund list, and we present clients with a strategic solution. So we said, depending on the level of risk they want to take, where they are in their journey, then we present them with a financial solution, and we select investments, we asset allocate for those individual solutions. And I can only do that because I've got a very good chief investment officer sitting up in the gods up there. And he's pretty talented at picking those funds and picking the asset allocation. And I do see that there is a lot of challenge out there, but it is interesting that we will use predominantly funds. We'll use some investment trusts where it's appropriate to access markets. We'll use ETFs if we want to bring costs down. We're active, not passive, and I think there's plenty of room for the whole debate. And I think the state of flux of the industry and the chart and the pricing issue, I think, is very relevant. However, from my perspective, meeting with the client is I've got a set of objectives I have to fulfill for that client. If I fulfill the objective, the client perceives I'm adding value, the price is irrelevant. So I get it, that if a client's going to come in and look at my latest MiFID 22-page document that's going to try and explain to him over 5 years that he's 15% worse off, quite frankly, they're flicking over the pages even faster than they ever did before. There will be one that analyses that MiFID documentation. The purpose it has served to the consumer, the purpose it served to the consumer is absolutely a big fat zero. Has it identified a playing field, a clear playing field? No, because the FCA has created so much obfuscation around it. So at the end of the day, we're trying what we can do to say to a client, this is what we charge. We try to bold it on the MiFID thing. That's what I'm charging. The rest of it's down there and is relevant. And it is relevant because you're trusting in me to put your products into our clients' portfolios at a fair price. But I just don't think that's really where the client is. There are always going to be passive investors. They're going to be D2C investors. There's going to be everything out there. And our millennials are really key to that. And as an industry, we're so goddamn boring. I mean, I've sat through so many pitches that we won't engage with the millennials unless we change something really dramatically. And despite the millennials may not have very much money, and they're happy to go down their hipster bars in Shoreditch and not put money in their Nest pension or their workplace pension scheme, they will come into money. They will inherit money. Their parents will die. And they're the ones who are the future business that we need to capture. And if you look at some of these reports about intergenerational wealth, from man to woman, you're 50% chance of being kicked out as a discretionary manager. Mother to children, you've got about 2% chance of holding the portfolio. So we have to concentrate on our database and our client database and encapsulating our children. So I think it's a fascinating debate, but at the end of the day, it's about the value that me at the front end is adding and my team are adding to our clients that really matters.
Can I just clarify something? You said that you're active, not passive, but that's in the asset allocation, not the underlying funds. Is that correct?
So we're active in the fund selection, we're active in the asset allocation, and we will pick active funds where it's appropriate to do so. Yeah.
Okay. All right. So I wanted to pick up this point about intergenerational wealth planning, because I think this is a really important issue. And we had Otto talking earlier today about people who've been defaulted into a workplace savings plan. Of course, the savings levels are paltry at the moment. But one of the questions I think a lot of us have is if people enter the industry, or their first experience with investing is a digital experience. It's not getting a mortgage face-to-face, or it's not, see their parents' financial advisor face-to-face, but it's through a digital media. Does that change behavior in the long run. And the other question about that is that they are largely in passive investments. The participation in the market is just a passive participation in the market. Not just they're passive, the underlying investments are passive. Do you see that changing the characteristics of investors? Because we all have biases that are hangovers from our early experiences.
The only point I'd say about this is that it's so ridiculous, this, our industry, because you look at what's happening with some of the funds in Nest, just for a moment, with these workplace pension schemes. First of all, we're moving people over 25 years or 30 years into low-risk investments at the age of 65, where we already know they're going to live for 30 years, and the one best hedge against inflation is some kind of real return, which they're not going to get from bonds and cash. And when is the return from bonds and cash going to change? Certainly not in the foreseeable future. So the other thing I think about millennials, and I talk to kids in schools and all sorts of things about this, is that they will go online because there's nobody else to serve them, and they are interested and they like apps. And let's face it, that natural instinct to want to make money, sort of greed is good kind of thing, will appeal to them. And whether it's doing it on a socially impacting perspective, which I think is really relevant, but also they've got to accept, and everything's going fine when the portfolio goes up. Starts to go down, my mates call me. My daughter's lost money on this nutmeg thing or what have you, and what should they be doing? And is there anything they can, do people really understand investment risk? I mean, kids barely understand how to budget at university, let alone investment risk. So there's got to be a greater education program about the need to take risk and so their interaction with, I think, the online tools.
Can I challenge that? Is it an education program, or should the risk not sit with the employer and the product provider? Because at the moment, the default fund is chosen by the provider and the employer or the advisor
as deemed by the regulator.
As deemed by the regulator. And so who would be willing?
So you can be assured that it'll be a completely boring and utterly useless fund.
Absolutely.
By and large. But it will be really low cost.
It'll be low cost.
Any minute now, Heather, you'll be suggesting that they should pay 4% into a contributory DB scheme. We'll be right back where we started.
You just wait.
I mean, I think from our advisory perspective, and I absolutely take the point in the direct market, I don't necessarily see that our customers of the future are coming from that base that has started off investing in that way, rounding up pennies through Money Hub or through another route. However, we do, to pick up on your point, Petronella, I think, in our business, we've got 40 advisors, and in our business, we're only now beginning to get the advisors to understand that they need to start engaging with the kids of clients far, far earlier. I would often say if the first time you've met the kids is at the reading of the will, the game's over, the cash is out. Yep. This is absolutely vital to start explaining to existing clients that we can help their kids get mortgages, that we can help them save modestly in a sensible way, that they can make sure that they understand what they have to do if they have powers of attorney, that they do understand what's said in a will, and all of those things that can be drawn into the advice that traditionally would just have been given to the parents. We're now starting to see ourselves trying to cascade further out, and that's as much about protecting as it is about replenishing the client base.
Yeah, okay. I want to get back to the shape of flows, and I had shared earlier our view that asset managers are going to need to be cheap or exceptional. So we had this Feemageddon thing in the FT last week with the rise of cheap active in the US. So we haven't really seen that here yet. But is that true? Do asset managers need to be cheap or exceptional or participate across the supply chain in strategic partnerships? Mark, can I start with you?
They need to make money. I mean,
they need to make their customers money, or they need to make money themselves?
They need to make. It's really the whole. I don't know. I'd be interested to see what you guys say. But the whole fee debate, about asset management side is. I mean, yes, we spend our time trying to knock the fees down. I mean, why wouldn't we? I mean, we're a big company, and one of the first things we'll talk about is, well, what fee can we get? Can we get it lower? I mean, we're trying to bring the fees down. I don't actually see any problem with that, although you would think in the press in the last 3 or 4 months that might be a problem.
You're a Satan.
Yeah, I'm a Satan. It's really, really weird when you're trying to get prices down, and you've got some guy called Terry Smith who's charging double the price of other people for less of performance or no better. But actually, the clients, what's really interesting is speaking to whereas we are partly a direct business, I do actually speak to clients. I used to be a kind of IFA, so I like to talk to clients anyway because they give you great feedback. Clients are fairly simple. They don't give a damn about Terry Smith. And one client said to me, he could charge 4% if he's going to give you performance like this. I said to him, don't tell Terry Smith that, because he will. So right now, you know, he's a great example of someone who's had a great tailwind. We can argue about I mean, I think his investment process is fine. I've got no problem with it at all. But it has got a fantastic tailwind, along with people like Lindsay Train, and sooner or later, it'll tail off. Something will go for a while, and then suddenly cost becomes perhaps more arguable. But actually, what most clients do now is just sell it. And actually, in terms of future fund, I mean, what I find really depressing is I'm a patient investor. I'm actually like tiny percentage of people now, because people just have got the 1 year performance and you're out. It feels like that's the way we're sort of going. I kind of see it with the whole Woodford thing. Don't really want to get in an argument over that, but I had it with Anthony Bolton, and still people say to me on Anthony Bolton, yeah, but he lost the plot, didn't he? I mean, he did retire well. Well, he actually beat the benchmark, and now look at the fund price now. But look at the prices that clients got scared out of that fund. Round about, you know, if anyone followed it, 70, 80p. I don't know what it is now, £2.50 or something. So people's attention span, I find it really difficult. So all these things like cost are involved, but actually the bottom line is clients want to make some money. It's never changed.
I mean, I think
it's understandable.
It's not really my place to sit and give free consultancy to the asset management industry. But there was a time I would have charged
for it. They paid good money for this.
And added that onto the bill. Yeah. But it is woefully oversupplied, clearly, and there are far too many fund managers doing far too much mediocrity, trying to be all things to all men. And I think the whole argument for why open work went down the route that it did, apart from having a bee in its bonnet that it let SJP do it 20 years earlier, was because it recognised that it was buying £1.5 billion worth of mutual funds every year. And because it was buying them right across the industry, it was paying exactly the same price, or its customers were paying exactly the same price as a one-man band IFA in Milton Keynes High Street. And that is bonkers. You know, it should have been able to operate in a cooperative way that pooled that cash together and used its buying power to benefit itself as the person taking the risk of running that business. And it was particularly important for open work because it was losing rather a lot of money at the time. Not now, but it was losing a lot of money at the time. So both to raise money for itself, but also to give a better deal to the customers. And that was really what it was about. But if you look at that from the other lens, of course, what that means is that there's a whole bunch of asset managers who used to be netting off close to 65 or 70 basis points on my customers' money were now being paid closer to a third of that. So you can see the value moving away in the advised sense as more and more money starts to get captured in propositions like ourselves and SGP and Intrinsic and so on. Right. And that's a big shift.
Yeah. I'm going to take a comment from Petronella, and then I'm coming to you. You're warned. Get your hands up.
Got Heather and I either side.
Go.
No, I mean, I think so, yeah, I agree. I mean, I completely agree with you, Mark. I think the fund charge is the fund charge. It's about the value we're adding by blending funds and making sure we're keeping on top of all the different funds. Yes, I think there's too many funds. I agree there's too much crap sitting in the industry. And the fund management industry will sort that all out for themselves eventually. And, you know, there are too many funds probably with retail fund charges that, you know, asset managers are sitting on. And there's lots of stuff that needs to be cleaned up. And hopefully the regulator will gradually get to all of those bits. And so what we end up with is a market that the consumer trusts, which is the first thing we need to solve, because actually the consumer is still very, very distrustful, and things like the charges debate doesn't make the consumer feel any more confident because they just think they're being overcharged all the time and they can't perceive what the value is.
But how does a fund manager get into your clients' portfolios? Do they have to be cheap or exceptional? Or
no, they have to be good. I mean, we're using the term elite fund managers now. So we've got our elite fund managers, and that's the top 20 of our 100 Centurion list. But we have sort of the squad and then the players who are fit for the squad. Now, we may have players or asset managers in the squad, but their portfolio is out of favour, but their portfolio may well come back into favour very quickly, and we need to know that we can pick on that fund as the economic situation develops. So we'll have those sort of sitting, waiting, resting when it's appropriate for them to come back in. So, and the other big thing for us is we're more and more buy and hold. I mean, this short-termism in markets that you've just referred to is really relevant. IFA's going, oh, the fund's just lost it a bit. I mean, I remember going back to Woodford in 1998 and Hargreaves saying, Woodford's lost it, you know, and it's like, actually, you know, and then everyone sold out of it.
I didn't actually say that, didn't I?
Well,
I was one of his few defenders.
The press said that. The press said that.
The press are good at saying
You know,
that.
but it's like, and then 2 years later, it's just because his fund was out of favour in that economic environment. You've got to
Exactly.
understand what a fund is doing in a specific. So, is it the fund manager underperforming,
Correct.
or the fund manager's stocks underperforming in the economic situation? And that requires skill, and that requires a chief investment officer or somebody who understands those. But the funds need to be available. So for a fund manager to get into us, and we've got some commandments, probably alongside that Hargreaves do. We want fund managers to have skin in the game. You know, we want to know that that fund manager's been through different seasons. We don't want the bumblebee fund manager. We've got a set of criteria that we use. And
So what's the bumblebee fund manager?
we're sort of up, down. Kind of fund manager.
I don't know if
I don't
everyone
know,
else
it's
do
just
that.
my crazy terminology. No, but they're kind of going, you know, they're kind of 1 minute they're top, 1 minute they're bottom. We want a degree of consistency. You know, I'm not the one picking the funds. I'm not the one doing the selection process. I know that we have an internal process that gets them onto there, and they've got to be justified at each investment committee meeting. But we run a tight list. I do think there are too many, but what I do like is innovation. So we are able to get into those smaller funds, which we do like, the born boutique fund managers that maybe are too large for some of the bigger players that are out there.